Good morning, good evening, guys. A very warm good evening to all of you. So let's wait few minutes. We will be starting with a new module. I got to know that Introduction to Investment Banking was completed for the batch of 0224. So today we will be starting with a different module, that is Introduction to Financial Statements. Congratulations, very warm congratulations and blessings to you, Ritik. Thanks a lot, Ritik, for the information. So our beloved Ritik is blessed with a baby boy yesterday, and this is what he wants to inform to the class. That's why he was not able to join yesterday. So let's everyone come together and extend our heartful congratulations to Ritik. Congratulations, Ritik. May God blesses him with all the happiness in the world. So yeah, yesterday we discussed about cash equities. We saw what are various type of corporate actions that corporates usually follow. We saw stock split. We saw uh, share repurchases, buyback. Uh, we saw different types of securities that is been issued, like preference shares. How preference shares are different from debt securities and equity securities. All these things we saw yesterday. Few things that we were left with is what we are going to conclude today. But let's wait for a minute more. Let's wait so that the class strength improves a bit, and then we will start. Good evening, everyone. Finally, two things that we need to continue about being done with cash equities, and then we will start with a new session, that is Introduction to Financial Statements. Uh, so what we wanted to discuss was about market capitalization. Now, what is market capitalization? Basically, I think we had discussed this in previous lecture. It's the formula for market capitalization is current market price multiplied by number of shares. So this is a hypothetical scenario where we assume that if we want to buy, yes, your message is visible, dear. A very warm good evening to you. So let's start with the session. We specifically need to be thorough with for the interviews. Management is not clear about the same. I have raised the ticket but not appropriate reply, because out of the entire syllabus it would be just practical to mug it or study and recollect it all. I will guide you on that, Arti. I will guide you on that, but uh, thus there are some important modules out of the whole curriculum of 6 months, and that important module is going to be covered from the next week onwards for the next 2 months, and that module is related to financial modeling part. manual WAC, we will see that how WAC will be actually calculated and implemented while being in this module. So all the curiosities, all the questions that you have, all the implementation part that we will see, everything that we have studied now in the next 2 months, it would be the time to implement all those things into the picture while making a financial model through Excel. The file was being downloaded. Can you resend it? Yesterday's notes couldn't be downloaded. You left the session while the file was being downloaded. Can you resend it? Okay, I'll resend it. Just give me a second. Uh, so yeah, I have uploaded the sheet on the chat box. Yes, dear, please let me know what doubt do you have. Dear, please reply. I'm waiting for you. Please allow me to start. So this is a hypothetical scenario where we evaluate actually that what is the total investment that we need, what is the total amount of money that we need if we want to buy the whole company. It means that all the equity shares of a given company. Now, yesterday we completed about stock exchanges. We saw that there are different exchanges, NSE and BSE in India, although there are exchanges like New York Stock Exchange. Then there is NASDAQ. NASDAQ is basically an index. Then there is Shanghai Stock Exchange for China. We have Hong Kong Stock Exchange, Japan Stock Exchange, Shenzhen Stock Exchange, and each and every country who have a well-developed equity capital market have their index. Okay. So the benchmark, when it started around 6:45. There might be a technical glitch, Singha. So there might be a technical glitch, and because of that, we might be having trouble. But don't worry, we have not started anything yet. We have just discussed the formula of market capitalization, where the formula of market capitalization is current market price multiplied by number of shares. So if you want to buy all the shares of the company, what is the amount that you need to invest is what we are going to see. Indices are different from markets. Indices are benchmark. So once one company is listed, it can belong to an index, it cannot belong to an index. So if Nifty is the index, Nifty is the, when I talk about Nifty, it comprises of top 50 stocks. But when a company is newly listed, it may not possibly directly be in the top 50 stocks according to the market cap, right? So the stock may be listed in an exchange, that is NSE, but may not be the part of Nifty. Not every stock listed in an exchange is the part of the benchmark index it covers. Yes, intro to IB is rescheduled to some other date because there was some confusion between the schedule. Once we are done with cash equities now, we will be starting with introduction to financial statements, and that is going to be a very exciting part of the session. Okay. Now, the question is one important aspect that we need to evaluate, that let's suppose we have an Indian company. which is being operated in India. But I want to raise funds from US citizens. How can I raise funds from US citizens, and how can US citizens invest in Indian companies? Any idea how? One option is I can go to US and come up with a full-fledged IPO, but that would cost me a higher amount in commission to investment bankers. The regulatory requirements I will have to follow, and also the compliance that I will have to make sure during the period I am listed in the US stock exchange. A very much simplified path to do so, or to raise funds from a foreign country, is through depository receipts. Let's see what are depository receipts. Depository receipts are defined as a negotiable certificate issued by a bank representing shares in a foreign company traded on a local stock exchange. Now, basically what happens if Tata Motors issues there is nothing much discussed in the first slide, though if you want to take the pick, you can take the pick. Okay, shall we move ahead? Let's suppose if Tata Motors wants to raise funds in US dollars from US citizens, the cost of coming up with a full-fledged IPO would be very high for Tata Motors, and not every company could afford it. So a better way to raise those funds and get the funds from a diversified pool of investors, depository receipts come into the picture. So there is a local investment bank in US, where you will be depositing the shares of Tata Motors, and on behalf of Tata Motors, that investment bank will be issuing the shares, or issuing, those are not called shares, though the security that they actually issue are called DRs, that is depository receipts, to the local citizens of US who are interested in investing in Tata Motors. So the parties involved in a depository receipt is the issuing company, Tata Motors in our example. Yes, I will explain again. Just give me a second. So basically what is happening, let's suppose if I want to raise funds from US citizens in American dollars, in US dollars. So we have a pool of investors in US. Those people wants to invest in Indian stocks, and there are companies in India which want to raise funds from USA. Now, one way is what Unilever followed. Unilever can come to India, establish a corporation over here, file the regulatory requirements, and come up with the IPO. But not every company can bear the mezzanine financing cost of IPO. So the period where a private company goes public, the cost involved in that period for coming up with the IPO is called mezzanine stage of financing. That mezzanine stage, that mezzanine financing cost cannot be funded by every company. Not every company would afford to do so, to go in every other country and raise an IPO over there, come up with an IPO over there or launch an IPO over there. So for those people, depository receipts come into the picture. Depository receipts helps the issuers to raise funds from a diversified pool of investors and helps the investors to invest in securities in the diversified geographical pool of asset classes. What I mean by that is, let's suppose there is a issuing company, Tata Motors, which wants fund from US citizens. So what they would do, they would go to a depository bank. They would deposit these shares. They would deposit these shares of Tata Motors to the depository bank, and depository bank on behalf of Tata Motors will issue these shares to the US citizens, issue these securities to the US citizens. They will issue securities, collect funds, and provide these funds to Tata Motors. And for doing so, they will charge a commission. If that security is issued in US, it is called American Depository Receipt. While in other parts of the globe, if the depository receipt is issued, it is called GDR, that is Global Depository Receipt. If it would have been issued in India by an Indian depository bank, it would have been called Indian Depository Receipt. Okay. With this conclusion of the small part, we are done with cash equities. The next module that we are going to start with is Introduction to Financial Statements. And AR, you asked me, yes, it can also be said as custodian bank or custodian. Custodian is basically the person who is responsible to keep your securities in place. Custodian is a person where you pledge your securities, and not pledge is not the right word. So where you keep your securities or deposit your securities is called a custodian. So introduction to financial statements. Someone asked me, I guess AR asked me. Yes, it will be provided to you via LMS or through mail in the coming week. That what is the most important modules while preparing for the interviews. So guys, I want to highlight this, that introduction to financial statements and keen information about financial statements is one of the most important module or most important part while preparing for the interviews and real life interviews. Maybe I have not heard about it. Is SHCL a bank? Because first time CK, the concept of depository receipt was started in America. That is why ADR. Global depository receipts are basically traded at different part of the world under the common denomination. But if you talk about Indian depository receipt or American depository receipt mandatorily will be traded in US dollars. Indian depository receipts will mandatorily be traded in rupees, Indian rupees. Yes, we will be discussing that part as well. In fact, we will be constructing the three statement model in our next class. And by analyzing that model itself, you will be very comfortable in analyzing the financial statements in the annual report. Okay, so let's start. Let's start with the model. Let's start with the module, sorry, on introduction to financial statements. First of all, what are three types of financial statements? No, today is not the last class. How come today can be the last class? Yes, when basically, actually not every time GA, but because it depends whether your capital markets are such well developed, are DRs being traded in the market, then it would impact the currency. It would affect the currency. If it is very thinly traded, then maybe not. So it actually depends on a lot of things, GA. And the one of the major thing is how well developed is your capital markets. I have not seen Indian, at least retail investors who have invested in DRs or depository receipts. So if there is no retail participation entitled to those depository receipts, DRs may seldom affect the currency of a particular nation. Okay, financial statements is already covered in March batch. Are we done with introduction to financial statements as well? Where we covered in income statement, balance sheet, and cash flow statement. Okay, I'm receiving mixed response. Guys, give me a couple of minutes. Let me check with the team that what is the issue, why this is happening. For 0224, it has been covered. For 0424, it is not covered. For the batch started in February, it has not been completed. Okay, perfect. So let me just give me 1 minute, and guys, please be there. Those who have joined from 0224, let me just open the model in front of you or the curriculum sheet in front of you. So guys, this is only with respect to 0224, because the issue is with 0224 only, because 0424 all the things are getting matched. I know what are the topics that have been completed, what are the topics that have not been completed. Okay, so 0224, guys, those who have joined from 0224, please reply this time. We did not study introduction to IBK. I guess you are talking about the batch 0424. I'll come to the batch 0424. just give me a second. 0224, please let me know that which of these modules have you covered. Are you done with basics of finance? 0224. Okay, you are from, I guess, 0424. Okay, so 0224 is done with basics of finance, basics of economics, and introduction to IB. Correct? Microsoft PowerPoint 0224. Are you guys done with this? Okay, most of you are saying no. Usman, probably you might have missed it, but going for the majority of the consensus is what they are saying. Okay, basics to advanced Excel. DK, guys, just a second. Some of you are saying yes, some of you are saying no. DK, which batch are you from? KK, which batch are you from? Because everyone else is saying okay, 0224. So DK, if you are from May 2024, your batch is 0424, not 0224. If you have started in fourth month or fifth month, your batch is 0424. I am talking about only 0224 now. Only 0224. Okay. Basics to advanced Excel is covered. Cash equities is covered. I covered cash equities yesterday. Introduction to derivatives covered. Fixed income securities covered. Asset management and mutual funds. Asset management and mutual funds is covered for you. Perfect. Introduction to financial statements. You guys are saying it is covered. Okay. Is it covered, guys? 0224. For 0224, it is covered, right? All these modules are covered till here. Perfect. I'll share this. I'll share this. It will also be uploaded on the LMS. Don't worry. So for 0224, your lecture is, you can take an off for the day. If you want to sit, you can sit. But those who feel that they are done, they are completely comfortable with the module, it's perfectly fine. If you feel like you want to sit, you can sit. But if you feel like you are done with the module, guys, how are you guys able to find your batch number? Please let me know. Usman is confused which batch he is from. Usman, when did you started with your lectures? The batch which had started August. Sure, sure. I'll look into that AR. I actually asked them to upload it. I don't know what. For zero batch 0424, we have attended only live lectures or recorded sessions to batch 0424 late admission. Don't worry. There are still a lot of things to be covered for 0224. We are starting with the lecture for 0424 now. You can see your batch ID. Where we can see our batch ID. Batch started June. Go to lessons in dashboard, and there you can see, there you will be able to see your batch IDs. Okay. So over here, yes, you can also find it in courses. There you will be able to find your batch IDs. So those who want to sit for this lecture, please sit for this lecture. From the next time onwards, that is from the next lecture onwards, everything will be starting fresh and it will be common for all. And also one important thing before leaving, please listen to this. One important thing, the notice that I have to make, the team has asked me to make, is from next week onwards, your timing will be changed. Some students requested for a change timing, and probably due to merging of some batches, there would be a new timing. Okay, for 0240, if you are from 0424, don't worry, I know everything about 0424, which batches are there. Probably the timing will be 9:30 to 11:30 IST, Indian Standard Time. 9:30 to 11:30 IST, Indian Standard Time. Okay. Night at night. 9:30 to 11:30 p.m. 9:30 p.m. to 11:30 p.m. for both the batches, for 0224 and 0424 both. You will be having these timing. Okay. For the next 2 months. SG. So yeah, we had some of our international student. PT, your batch code will be viewed on your LMS profile. Okay. You will have to visit your LMS profile, go to the learning course or course tab, and there you can see your batch. So yeah, 0224 can leave. 0224 can leave. It's perfectly fine. Those who have joined from 0224 can leave. If you are not comfortable about that timing, you can raise a ticket about it. Okay. Yes. For 0424, the topics that are covered, I guess it starts from economics, then derivatives, fixed income, cash equities. Is there anything else covered for 0424? Cost of capital, yes. Yes, and asset management and mutual funds. These 6 modules are covered for 0424, correct? Today, we will be and currently joined since I couldn't complete the batch due to some reason confused. I joined the batch last week. Don't worry, RH. Don't worry, RH. Please raise a ticket about it and we will sit one-to-one because yours is the special case. You have joined in 0623 and now you are repeating your curriculum. So please raise a ticket about it. We will sit one-to-one and talk about it. This is for batch 0424 and we are here on Introduction to Investment Banking. Yes, all these lectures have been started from May. Introduction to Financial Statements, sorry. Introduction to Financial Statements. Okay, so this is for 0424. Now confusion is resolved for everyone. Shall we start? Yes, we will be starting. Even I have taken a pic of this so that I can provide this to the team and they will tally before scheduling the lectures. PT, when did you started with your lecture? Did you started in May? Yes, yes. 0224 can leave. 0224 can leave. Enjoy the rest of your day, guys. Bye-bye. Have fun. Your batch code could be viewed under your profile section. I can't individually remember each of your batch code, right? So your batch code can be viewed under your profile section. So let me show you how can you view that. You can go to the student portal. You can go to the Learn tab. you can go to your home page of the LMS. You can go to the dashboard, and there you will have your batch written over here. Since I have got my student ID updated in all the other batches, I have been showing this. So if it's shown February to August, you are from 0 to 24. If it's been showing April to October, then you are from 04 to 4. Okay. So make sure you know which batch are you from. Okay. If no batch is showing BK, please ask your counselor about it. Please raise a ticket about it. Let's not waste much time. Everyone who has not covered introduction to financial statement will sit for the lecture and listen to the lecture. Okay. Let's start with the session. For this, yes, Ritik, if no batch is showing, you can raise a ticket about it. The team will get in touch with you and help you out why any batch is not being showing to you. Okay. When did you started with your session, Ritik? In April, May, in the month of April or May, right? So if that is the case, you are from 0424. Anyone who has started before February or on February or before March, they are from 0224. Okay, let's start. Let's start. Perfect. Let's start. So what are three financial statements? The first one is income statement. The second one is balance sheet. And the third one is cash flow statement. The first one is income statement, the second one is balance sheet, and the third one is cash flow statement. What is income statement? Income statement shows you the financial performance of the company. Financial performance of the company. The balance sheet, on the other hand, shows you the financial position. And the cash flow statement shows you the sources of although you can request about it SK in the chat in the through tickets, but I'm not sure whether you could do that or not. Try raising a ticket about it. Okay. Income statement, balance sheet, and cash flow statement. Let's start our discussion with the income statement first. What do you know about income statement? What do you guys know about the income statement? What is income statement? So the financial statement, which gives you the information about the income and expenses of any business. The financial statement, which gives you an information about income and expenses of the business, is called income statement. Okay. So what are the sources from where I am generating my income, and what are the sources where I am spending on my business is what income statement gives. Income statement starts with sales. It's also called SPNL, profit and loss account, because at the purpose of income statement is to know that at the end of the year, whether you have generated a profit or whether you have Sorry, guys. Sorry. There was a technical glitch. Sorry, the class was interrupted in between. I don't know what has happened today. Everything is not falling into the place. I don't know why. Okay. Now, guys, are you able to hear my voice? Perfect. So we were discussing a specific format. Guys, now I am clear, right? My voice is clearly audible, right? So Vaishnavi, this time probably the issue might be from your end. So make sure that you switch to a better network region. Okay, let's start. So the first part, first line item of the income statement is sales. What is sales? Sales is revenue values that a company generates. What is sales? Sales is nothing but revenue that a company generates. So let's suppose if you have sold 100 million of goods in a particular year for a particular period, 100 million will be your sales value. Okay. Now the next line item is COGS, cost of goods sold. Next line item is COGS, that is cost of goods sold. The revenue that you have recorded of 100 million, you might have incurred some cost, right, to procure that revenue, to get the materials. So let's suppose the cost of producing and manufacturing and allocating all the resources that I needed to sell this 100 million worth of product is what my cost of goods sold is. For example, that, let's say I am talking about Maruti Suzuki. Maruti Suzuki sold cars worth rupees 100 million. To manufacture those cars, what is the cost that Maruti Suzuki has incurred? That is cost of goods sold. Okay. Are you guys clear with this? Cost of goods sold. Shall I move ahead? If yes, guys, if do you have any doubt, guys, in the first two line items, revenue and COGS? COGS, I'll repeat again, sure. Let's suppose, Nikamni, that you have sold, you are the director of Maruti Suzuki, you are the CFO of Maruti Suzuki, and in a given financial year, you have sold 100 million worth of cars. Fair enough. So if you have sold 100 million worth of cars, 100 million is the revenue that you will record. 100 million is the worth of sales, is the amount of sales that you have made. But what was the amount, what was the cost that you incurred to manufacture this 100 million worth of cars is what cost of goods sold is. Nikamni, are you clear this time? Nikamni, are you clear? So let's suppose you have sold 100 million worth of cars. To manufacture those cars, your cost was 30 million rupees. Your manufacturing cost for to manufacture these cars was 30 million rupees. So after deducting cost of goods sold from revenue, the amount that you are left with is gross profit. The amount that you are left with is gross profit subtracting what is gross profit? Gross profit is nothing but revenue minus cogs. I have I have sold something for 100 million. I have bought those things for 30 million. The amount I am left with 70 million. Is this 70 million the amount that I can take home? Is this 70 million the amount that I can take home? No, absolutely not. Because I have to pay salary expenses, my utility bills, rent, all these things, right? My marketing expenses. So after subtracting operating expense from my gross profit, I will get some will be subtracted from my gross profit. Then selling and selling and distribution expenses. This is called selling and distribution expenses. This will be subtracted, and ultimately, after subtracting these two amounts, which are nothing but your operating expenses, you will be left with something called as EBITDA. I will explain each and every line item in EBITDA, but please let me know. I'll explain again. Let me explain again, and then I'll ask you that whether you are clear with it or not. So I have bought something. I have sold cars for $100 million. The cost of producing those cars were 30 million. So I am available with 70 million gross profit. But is this 70 million is the amount that I can take home? The answer is no, because out of this 70 million, I have also paid some salaries to my employee. The business has paid some salaries to their employees. The business has paid some rent. So all those expenses that are required to manage my office, to administrate the office, to run that office, to keep the operations going on are called operating expenses. The two main classification of operating expenses are office and admin. The second one is selling and distribution. To sell my products, I would have run the marketing campaign through Facebook ads, through television ads, through posters, banners. I would have published some brochures to market my product. To deliver my product, I would have incurred some transportation cost. All those things are the part of my selling and distribution expenses. 100 million was the worth of goods I have sold. 30 million was the cost to produce those goods. 70 million was the amount I was left with. Let's suppose 10 million is the salary and rent expense. 20 million is the marketing cost. So the amount that I am left with is now 40 million. That amount will be characterized as or categorized as EBITDA. Please let me know if I am not clear up till here, so that I can move to the next slide and guide you on what is actually EBITDA. So EBITDA is earnings before interest, taxes, depreciation, and amortization. This is my EBITDA. Earnings before before deducting any interest cost, any depreciation expense, or any amortization expense. Earnings before deducting any interest cost, any taxes, any depreciation expense, or any amortization expense. So the earnings that I am left with before deducting any interest cost, any taxes, any depreciation, or any amortization is what EBITDA is. I have not explained what is interest cost, what are taxes, what is depreciation, and what is amortization. I have just named EBITDA it. I am coming to the most confusing part all of you are talking about, that is spend few minutes on the depreciation as well. When we will be making a three statement model in the next class, I will be discussing each and everything in detail again. But here as well, I am discussing this. Please pay 100% of your attention. In the next class, this would be repeated again because you guys told, right? Some of your batchmates from 0 to 24 told me that this has already been completed. But trust me, guys, when we go to the modeling part, these things which have been completed 2 months earlier, no one remembers this. And this is the most important part of the curriculum. So I will spend time on this. But please let me know everything is clear till here so that I can move ahead. Fair enough. I am stopping. I am stopping. Income discussion for income statement till here. And I am starting my discussion for depreciation and amortization. To understand that, I am explaining EBITDA. I will revisit EBITDA. Just give me few minutes. I will come to EBITDA again. But let me just explain you one concrete concept. Okay, are you guys done? Income statement, balance sheet, and cash flow statement. Income statement, balance sheet, and cash flow statement. Yes, yes. I have not explained amortization. I want to explain amortization. To explain that, I have taken a step back and I'm trying to explain you how these statements are actually made. Income statement is for the period. Balance sheet is as on date. And cash flow statement is again for the period.
Coming again, income statement is for the period 1st January to 31st December. This is the financial year and the calendar year both followed in US and other European countries. In India, the financial year is from 1st April to 31st March. I will start with this example and I will keep this example for discussion. Consider this as a financial year. All the values recorded in the income statement are for the period. When I say it is for the period, all the instances regarding income and expenses that has happened during 1st January to 31st December is being recorded in the income statement. So there is a start date, that is 1st Jan, let's say 24 to 31st December 2024. All the income and expenses happening during the period between 1st Jan and 31st December, may it be the sales recorded or the revenue recorded, may it be the cost that you have incurred for selling those goods, may it be the salary expense, the office expense, the admin expense, or any other expenses. These are, may it be the depreciation expense, may it be the interest, taxes, anything. All the values recorded is for the period. For the period means between these two dates. Am I clear on making this point? Please let me know. Have you understood what I am trying to explain? Fair enough. Fair enough. Hold on your thought for a sec. Balance sheet is as on date, which means balance sheet, if I am making, I will make on 31st December. The elements of the balance sheet are assets and liabilities. This is as on 31st December. It means since the inception of the company, the time from which the company has started till today, what are the assets that company has and what are the amount that company has borrowed. Everything is being incorporated in the balance sheet. It shows the financial position of the company right from the inception of the company till today. Are you getting the difference? Over here, we had a specific and defined period. Here, the period is not defined. The exact days between these two dates is not defined. From whenever the company, whichever may be the company which is started, right from the inception of the company till 31st December, what is the assets that company has owned and what are the liabilities that company owe is what recorded in the balance sheet. Are you guys clear with this? Income statement and balance sheet. Are you guys, anyone has any doubt till here? Please let me know. Please stop me here itself. So Vaishnavi, was this yes for everything is clear or was this yes to make me repeat it? Perfect. Anyone has any doubt, please stop me here itself. NB, Anyone else? NB is asking me to explain again. Anyone else who wants me to explain this again? I am waiting for your response. Try to look into this. Try to see what I am trying to mean. Anyone else who wants me to repeat this again? Inception is the date at which company started. The company initiated its operations. The date at which the company initiated its operations, the date at which the company started. Okay. NB, I am repeating this for you. Income statement is for the period. The term for the period means between two specified dates. It means that the revenue, the COGS, the salaries, the offices and admin expenses, everything that has been recorded is for the period. So when I say that revenue is 100 million, it means that in 1 year, I have made 100 million. In 1 year, I have made sales of 100 million. Why 1 year? Because the period of 1st Jan to 31st December is the financial year, and between these two dates, I have made the revenue of 100 million. But when I say I own the asset of 500 million, my company owns the asset of 500 million. Right from when the company was initiated till today, company has managed to accumulate 500 million. Company has managed to accumulate this 500 million. This is what the point is. NB, are you clear with this time? Please let me know. NB, please let me know. Please allow me to repeat or move forward based on your understanding. NB, shall I wait or shall I move ahead or shall I explain it again? Please reply. Perfect. Similar to income statement, similar to income statement, cash flow statement is also for the period. It means that every cash inflow that has happened from 1st Jan to 31st December is been recorded in cash flow statement. Now the purpose for me to highlight these three statements was not to explain balance sheet, was not to explain cash flow, was not to explain asset and liabilities. The purpose was to explain for the period and as on date. The purpose was to make you understand these two terms. Am I successful in explaining you this? I am coming to what are assets, what are liabilities, what are the elements of the cash flow statement. But am I successful in explaining you what is for the period and what is as on date? Now, coming to what are assets? Assets are something that you own. Liabilities are something that you owe or borrow. Assets are something that you own. Liabilities are something that you have borrowed from someone else. Because when we borrow money from someone else, we are liable to pay them back. When we borrow money from someone else, we have an obligation to pay that money back. That is liability for you. And the equation for balance sheet is assets equals to liabilities plus equity. Assets equals to liabilities plus equity. It means that if I have 100 billions of assets, if my company has 100 billions of assets, either I would have contributed for those assets from my own pocket. Equity is called own contribution. Or I would have borrowed money from someone else to fund those assets. That is called borrowed funds. Are you guys clear with this? That accumulated profits are the part of equity. That will be a fancy stuff for now. Although that is something we are going to cover in the next class, that by making a 3-statement model. Okay. Next thing. My question is, I have purchased an asset worth rupees $10 million. I have purchased a machinery worth rupees $10 million. And I am going to use this machinery for the next 5 years. I am going to use this machinery for next 5 years. The question is whether I should record the expense of this machinery. By the way, since I have made the investment, which will give me returns for the next 5 years. This investment is called investment in fixed assets. Investment in fixed assets. Investment in fixed assets. Also called capital expenditure. What are fixed assets? Fixed assets are those assets that we use for more than 1 year. Fixed assets are those assets that we use for more than 1 year. Now, since I have made $10 million, or shall I distribute this expense over the next 5 years, 2 millions each for the next 5 years? Should I record 2 million expense each for the next 5 years? What should I do? What do you think? Yes, we will record it in the fixed assets in the balance sheet. That is correct. Since we have owned this asset, we will show that I own these assets worth 10 million in our balance sheet. But I am talking about the impact on income statement. Should I subtract 10 million and show 10 million as expense in this year itself? Or shall I show or distribute it in the next 5 years? So let's suppose after deducting after deducting all these expenses from gross profit, office and admin expense, selling and general expense, I am left with my EBITDA, 40 million. I am left with my 40 million worth of EBITDA. And in this year itself, I have purchased an asset worth rupees, let's say 50 million. In this year itself, I have purchased the assets worth rupees 50 million. So if I directly subtract this 50 million from my income statement for this year only, I will be showing 10 million loss. I will be showing 10 million loss. But instead, the 50 million that I have used in this year will benefit me for the next 5 years. This is not going to benefit me only this year. So how come I can blame this year that I have made a loss? Actually, I have made an investment which will benefit in the coming time. Correct? So the investment that I have made worth 50 million of machineries that I have purchased will benefit me in the next 5 years. So in the next 5 years, I will be subtracting 10 million each, 10 million every year for the next 5 years as a depreciation expense. Now, I will give you a different perspective to it. Let's suppose you purchased a machinery. Let's suppose you are going to run a company, a software company, and for that you purchased 500 computers worth 50 million. You purchased 500 computers or 5,000 computers for 50 million. Let's keep it 500. After 1 year, when you lost, after 1 year, when you want to sell these 500 computers, will you be able to sell it at 50 million? After 1 year, when you want to sell this computer worth 50 million, will you be able to sell this computer at 50 million? The answer is no. Does anyone buy second-hand product at the market rate? Does any logical person do so? Why? Why after 1 year you are not able to sell it for 50 million? Because you have used that asset, and because of using that asset, your asset is subject to wear and tear. Your asset is subject to wear and tear. Apart from this, if the useful life of the asset is 5 years, you have used 1 year out of it. So the remaining useful life is only 4 years. The person that will be buying this computer from you can use this computer for only 4 years. Okay, JS, okay. Please raise a ticket about it and I'll help you out. So the person that who will be buying second-hand computer from you will be using that asset for only 4 years. So the 1 year is the expense. 1 year is the expense of using that asset, and that is the depreciation expense. In the 1 year, you will record that expense of using that asset. That is called depreciation expense. Correct, AP. Yes, a car is a depreciating asset. Any asset that has a useful life is a depreciating asset. But is land depreciated? Is land depreciated? Why? Simply because land does not has a useful life. Now you guys were confused. You guys were confused that what is amortization? Amortization is nothing but depreciation on intangible assets. Intangible assets are those assets that cannot be seen or touched. Assets that could not be seen or touched are called. Okay. Are you guys clear with amortization? Examples of intangible assets: patents, copyrights, license, trademarks. Yes, I am explaining amortization, but are you guys clear with intangible assets? To explain amortization, I will have to make you clear with intangible assets first. Yes, the difference between depreciation and amortization is nothing. The simple difference is depreciation is charged on tangible assets, something that you can touch. Amortization is charged on intangible assets, something that you cannot touch. The best intangible asset is time. So let's suppose, how many of you have watched Friends? How many of you have watched Friends? How many of you have watched Friends? Okay. Let's suppose, who is the producer of Friends? I think Web Bros Production. Web Bros Production is the producer of Friends. Web Bros Production has produced Friends and spent 100 million in producing the 10 seasons. Okay. Web Bros Production has produced Friends. They have spent 100 million in producing the 10 seasons. How will Web Bros Production earn money? They will send or they will sell copyright of Friends to various media houses like OTT platforms like Netflix, Hotstar, and Amazon Prime. Let's say that Web Bros Production sold 5 years copyrights, 5 years of, let's call these copyrights as broadcasting rights, 5 years of broadcasting rights to Netflix. Let's say that these Friends producers have sold 5 years of broadcasting rights to Netflix. After 1 year, and Netflix paid them 20 million. Netflix paid them 20 million for 3 years. For the next 3 years, Netflix used this copyrights or broadcasting rights of Friends and earned revenue. Netflix broadcasted this Friends series on their platform and earned revenue through subscriptions. For the next 2 years is left for the maturity of these broadcasting rights. For the next 2 years, Netflix sells Netflix sells this broadcasting rights to Amazon. Netflix sells this broadcasting rights to Amazon. The question is, in the third year, when Netflix is selling this right to Amazon, will Amazon pay Netflix 20 million? Will Amazon pay Netflix 20 million? Guys, will Amazon pay Netflix this 20 million? Obviously not. Why not? Because this 20 million was for the next 5 years. It means that 4 million each year. 4 million per year. And since 3 years has passed, 12 million out of this is already being used. 12 million out of this 20 million is already being used by Netflix. How can Netflix ask for additional 20 million? Netflix can only charge them the residual 8 million because the only time remaining is 2 years. So the asset of broadcasting right that Netflix purchased for 20 million is now worth 8 million. So this asset has lost 12 million of its value. The prices drop, the price of the asset, the value of the asset has dropped from 20 million to 8 million. So there is a sharp fall of 12 million. This 12 million is nothing but amortization. This 12 million is nothing but amortization. Are you guys clear with this? Perfect. Now let's move ahead. So this was the most difficult part of the session. If you are clear with this, the rest of the session will be cakewalk for you. Please ignore this. Let's say 10 million is the depreciation, 2 million is the amortization. What is the amount? After deducting these expenses, what is the amount the company is left with? What is the amount the company is left with? Can I say a company is left with 28 million? After 15 to 20 minutes, we will be done with the session MS. Okay, let's take a couple of minutes break. I think you guys are getting really exhausted. Let's take a couple of minutes break, but before going to the break, just listen to this. The amount that the company is left with after deducting depreciation and amortization is EBIT, EBIT. Because depreciation of expenses deducted, amortization expenses deducted, we are left with EBIT. Take a 5 minutes break, but be right back on time. Take 5 minutes break, but be right back on time. EBITDA is nothing but earnings before interest, taxes, depreciation, amortization. Earnings before Yes, we are on a break, Apurva. We will be starting in next couple of minutes. Did the team get in touch with you, K? You probably might have received the mail about it. You probably might have received the mail with the PDFs. Please check your spam folder, your inbox, because I confirmed in the last class, people replied that they have received a mail with the PDFs. And if not, probably due to weekend, it would be delivered to you by tomorrow. I requested them to send you a mail. I personally called the guy who is responsible for it, that is Devansh, a very dear friend of mine, but I guess he might have mailed you. Okay, let's start. So over here, I am left with a bit. So over there in the ask a doubt itself, there might be a section which says that what challenge do you have? Is it regarding placements? Is it regarding the portal? Is it regarding the access to anything? Or is it regarding timings? And based on that, you can raise a ticket. So you might see a section where it says ask a doubt. Fair enough. What is EBIT? Earning before earning before interest and taxes. Earning before interest and taxes. Earning before deducting any interest and taxes. That is EBIT. But once we have taken loan, we have to pay some interest, right? So that is called interest expense. Once interest is deducted, let's say 2 million was interest, that is been deducted. I will be left with 26 million of interest is deducted. I am left with EBT, earning before taxes. Let's say I have paid 20% tax on my earnings at 5.2 million. I get the bottom line, that is PAT. 26 minus 5.2 gives me 20.8. That is my profit after tax, also called as net income. Also called as net income. Profit after tax is the profit that you generated through your business after deducting all the expenses. This is the profit at the end of the day that is generated by your business. That is profit after tax. And this is called the bottom line of the income statement, the last line item of the income statement. After this, there are Dividends and retained earnings, that is something that we will be covering in the next class. But about income statement, this would be sufficient. Equity shareholders, yes, EAS. Okay, that I can incorporate. If net income is available to you and you have to pay preference dividend, the amount that is left with EAS, earning available to shareholders. Although not every company has preference dividend, so not earning available to shareholders or earning available to equity shareholders, one and the same thing. So not every company might have preference dividend, so you will see most of the line item ending till net income only. Now coming to the next part, yes, we will be having the practical session on Excel in next part. So make sure that you have got your Excel updated and you are on your toes from the next class onwards. Which interest gets deducted? Interest on, yes. So if you have borrowed some funds, what is interest? What is interest? Basically, if you have borrowed some debt, let's suppose you have taken 100 million of debt at 2%. So 2 million will be the interest that you need to pay for the year. Any version is sufficient, but make sure that your Excel is fast enough. It does not gets lagged in between. That would make your lecture experience smooth. That is your interest cost or interest expense. Now coming to balance sheet. In balance sheet, we have assets, we have liabilities, and under liabilities section itself, we have equity. Why equity is also considered to be a part of liability? Simply because an accounting principle that says the owner is a separate entity from its business. The owner is a separate entity from its business. That is equity. That is why equity is a part of liability. The amount that the business borrow from its owner or the amount that a owner invests in its own business is called equity. In assets, we have fixed assets and then we have current assets. In liabilities, we have current liabilities. Correct. Business owes what owner brings into the business. We have current liabilities and we have non-current liabilities. So what are fixed assets? Those assets which will be in use in the business for more than 1 year. Those assets are your fixed assets. What are current assets? Assets that will be used for less than 1 year will be your current assets. More than 1 year and less than 1 year. Example of fixed assets: property, plant, equipment, machinery, land, building, patents with maturity more than 1 year, copyrights, goodwill. And we are going to have a very detailed explanation on goodwill on a topic that is M&A along with LBO. So what are patents? Let's suppose you have made a technological, scientific innovation or a technological innovation. Let's suppose you have manufactured mobile phones. Once you have launched those mobile phones in the market, there is a possibility that your competitors can map the technology or stole the technology away from you. That they can copy the design that you have launched, which is a unique design. They can copy the new feature that you have launched into their own mobile phone. So to protect the right of using the technology that you have yourself innovated, you will have to file a patent. You will have to request a patent where the government guarantees you that your rights for using that product or innovation or technology or a tool will be protected for a given period of time. That is patent. Example of current assets: cash and bank balance, not government body. You have to file the patent with the organization or the government, the local authority. Government bodies does not file the patent on your behalf. If you have made the innovation, you will have to file the patent towards a government body. So let's suppose you have designed a vaccine for coronavirus. I am explaining patent again for few people. For KV, let's suppose you have designed a vaccine for coronavirus, and let's suppose you are Mankind Pharma. So when will you benefit most out of this vaccine? You will benefit most out of this vaccine when you have the monopoly in this vaccine. If you have monopoly in this vaccine, you will be the only one to sell this vaccine and you will maximize your profits. And you deserve that because you have cracked the code. But if your competitors, Lupin, Sun Pharma, tell me other pharma brands. Tell me few names of other pharma brands, please. Cipla, yes. Dr. Reddy, Glenmark. If all these people copy the formula of your vaccine and publish that formula under their own name, will you be able to make that profit? Will you be able to make that profit? The answer is no. So to protect the formula that you have innovated, you will have to sign a patent. You will have to file a patent where you mention to the government authority that you have innovated this particular technology and you don't want to give right to anyone else to copy this technology. That is patent. This is of very much value in case of automobile industry. Some companies try to copy designs of other companies. So the patents are signed so that No two car models or car manufacturers produces the cars with the same design or similar design. But people often try to find the loophole by slightly changing or modifying the design and copying the same product. Fair enough. Current assets, cash. It can also might be registered with the regulatory authority of that particular industry. So if you are working in pharmacy industry, there might be a regulatory authority that might be governing the pharmacy industry. You can file the patent over there itself, there as well. But again, how the patent will be filed, as a financial analyst, as an investment banker, you don't have to worry about it. That is something related to lawyer or company secretaries. So those are the professionals that will take care about what is the exact process to file a patent. Nevertheless, being curious is one good thing to be having in your personality. That's nice. Okay. Cash, accounts receivable. It means that the goods that I have given to my customers on credit, I am about to receive it. So that is my current asset. Advanced, advances paid, advances paid, inventory. Debtors is nothing but accounts receivable. Accounts receivable is also called debtors. Debenture is current liability or long-term liability, depending upon the term of the debenture. Prepaid expenses or advances paid, same thing. And inventory, basically the goods that is in your godown that you are going to sell in the coming time. Fixed liability, loans taken, and what are the examples of fixed liabilities other than loans? Reserves are part of equity. Stocks, if you are talking about shares, then it is a current asset. Shares, shares that you hold, shares of the other companies that you hold, that is a current asset. If you are talking about your own shares, then it is an equity for you. Okay. Loans, borrowings, bonds issued. Basically, borrowed funds are example of fixed liabilities or non-current liabilities. Non-current liabilities. The liabilities that you will be going to pay off in the period greater than 1 year. Current liabilities, accounts payable, outstanding expenses, salaries payable, bills payable. All of these comes under accounts payable. Short-term loans, again part of accounts payable. So these were the elements of the balance sheet. The elements of the cash flow statement are: first and foremost, cash flow from operating activities. Yes, accrued income. Yes, you can show that in current assets. The income that you have delivered, the goods that you have delivered, but income is not received yet. That is the part of current assets. Operating activities, investing activities, and the third one is financing activities. What are operating activities? Basically, all those activities that are responsible to keep your business in operations, like payment received from customers, payment received, payments paid to suppliers, your electricity bill, your salaries that you pay, your utilities, all the expenses, yes, AP correct, all the expenses that is required to run your business on the daily basis, day by everyday expenses, day-to-day expenses of your business, day-to-day income of your business is operating activities. Cash flow statement is like trading accounts. Well, trading accounts, the accounting cycle, to be very honest, as a finance student, you will know when we will discuss more on this in the coming time that yes, I'll show the slides. Just let me complete this. That the credit what comes in, debit what goes out, credit the receiver, debit the giver, ledger preparation, trial balance preparation, profit and loss preparation. Trading account is, I guess, PNL, right? PNL is called trading account, correct? Guys, those who are from commerce background, because I had taken science in my 12th standard. So I am not very great with the technical accounting concepts. But as far as I know, as far as I can guess, trading account is PNL, profit and loss account. So income statement is profit and loss account. No, it's not trial balance. It's not trial balance either. It's neither ledger. The three important financial statements are cash flow statement, balance sheet, and income statement. The trial balance, ledger preparation, journal entry, all these are the process of making the financial statements. As an analyst, you don't have to be aware about the process of making these financial statements. Why? Because these are the work of accountants. These are what accountants do. We are analysts. Accountant will give us these statements in hand. We should be able to read those statements. We should be able to analyze those statements and make decision that what we can do to improve the performance. So GA, are you there? Still there? I guess you left. Were you left in between? Or were you listening all? So I took for your batch as well, right? I took the financial statements, right? Introduction to financial statements. I was the one who took that lectures, right? Perfect. Okay. So GA is sitting here really glad, still revising the concepts. Then finally, we have cash flow from investing activities. These are the cash flows made from purchase, purchase and sale of fixed assets. These are the cash flows that are cash inflows and cash outflows that are made through purchase and sale of fixed assets. Now, when will be the cash outflow? When we purchase the asset, we will be paying the cash. So that would be a cash outflow. When we'll be selling the asset, it would be a cash inflow because we will be receiving the cash. So purchase and sale of fixed assets deals with in cash flow from investing activities. The final point for the day, cash flow from financing activities. This is with respect to those cash flows that are involved with raising or repayment of debt. Raising or repayment of debt. Payment paid, payment received, payment, the payment received, here I am talking about payment received from customers. The payment made, here the payment that I'm talking about is payment made to suppliers. And these are rightly categorized in operating activities only. Investing activities and financing activities. Anything related to fixed assets will be investing, and anything related to issuance or repayment of debt or equity securities. Either it is related to debt or equity, it would be part of financing activities. If it is related to equity and debt, it would be the part of financing activities. That was it for the day, guys. Thanks a lot. I hope you enjoyed the session. Hold on for a second. Let me share the sheet with you. I hope you enjoyed the session. From next week onwards, the session is going to be really exciting, and it would demand a lot of efforts from your end as well. So be attentive in the class, keep practicing. I have uploaded the sheet in the chat box. You can see those sheets if you want. I can share and show you the last 3 slides. This was slide 1, 2, 3. Explain investing activities once again. Okay. Okay. The sheet is not visible. I'm explaining investing activities once again. Just give me a second. Any investments made in the fixed asset. Let's suppose you have purchased any property, plant, or equipment, or if you have sold any property, plant, or equipment. So if you have purchased, you would have paid for it in cash. It is a cash outflow and it will be recorded in investing activity. If you have made the sale, you will be receiving the cash. You will be receiving the cash inflow in investing activity. So activities related to purchase and sale of fixed assets are called investing activities. Activities related to purchase and sale of fixed assets are called investing activity. In sale, we have a cash inflow, and while purchase, we have a cash outflow. That is correct. Okay, RH. If that is the case, then you can connect to the team and they will help you out with what you can do. Cash equities. Okay, you are not able to see the link. Last 3 slides. Slide 1. Slide 1. Let me know if you are done, PT. Slide 2. And slide 3. So bye-bye, guys. Have fun. Have a great week ahead. Let's see you next week. So shall I end the class? What does balance and cash flow statement shows? Balance sheet shows that what are the assets that you own, what are the inventory available to you, the property you own, the plant you own, the machinery that you own, the amount that you have borrowed from people, the amount that you have to pay to people. These are what balance sheet shows. So it shows the financial position of the company. Cash flow statement shows that what are the sources of your cash inflows and cash outflows. Where are you spending your cash and what are the sources through which you are receiving your cash? That is cash flow statement. So bye bye guys. Take care. Have fun. Just make sure that you touch upon Excel. You have, since you are done with, those who are done with the Excel part, practice Excel. If you are not done with Excel, don't worry, we will cover everything from scratch. But just make sure one thing, one simple thing, that keep your Excel updated. Make sure that your Excel does not get hanged in between. It's okay to be using 2010 version or a 2006 version or a 2002 version. But the one important thing that you all should make sure that no, Google Sheet is not okay. You should use Excel only. Next week, we will be starting with the financial modeling part. Okay. So bye bye guys. Take care. Have fun.